If you want to make consistent passive income using one of the easiest investing strategies, then you need to learn the wheel strategy. Now in this video, we are going to learn exactly how to effectively use this option strategy for passive income in a safe and reliable manner. Welcome my friends to Pandrea Finance. My name is Alex Pandrea, and it is time for one of my favorite and most logical strategies out there when trading options. Now, a lot of the times option trading might have a preconceived notion of being risky, right? Oh no, be careful, you're gonna lose all your money. But that's really not the case if you understand a few simple but important things. So let's go ahead and break down each important factor, and once we understand these points, we can go ahead, combine them all together to make the wheel strategy and ultimately start making some money. The first thing that we need to understand about options is that there are two sides to option trading. You can either be a buyer of options or you can be a seller of options. If you are a buyer of option contracts, you are buying option contracts and then hoping that the price of your contract goes up. This is usually a very risky trade because you need to be right not only on the direction of the stock move, but also you need to be correct at what price the stock will reach and when that stock will reach that price. And if you are not correct in all of those things, essentially you'll lose all your money that you invested. So good job. Now on the other hand, you have the option sellers, which take the opposite side of the trade. When selling options, you are collecting a premium paid to you by the option buyer, and you win the trade if the option buyer doesn't get all those factors that we just mentioned correct. So the chances are way in your favor if you're on the side of selling options. Now, because you have this high probability of success, you are taking on some obligations. When selling calls, you are taking on the obligation that if your stock reaches the strike price, then you will need to sell shares of the company at that price. You are forced to sell shares. When selling puts, on the other hand, if the stock reaches the strike price, then you will be obligated to buy shares. You will be forced to buy shares of that particular company if the strike price is reached. Your goal when selling options is to collect the premium and then hope that the stock does not reach the strike price. If the stock price does not reach the strike price, then the option contract that you sold will lose all its value. This is a good thing, and this is what you want to happen when selling options. This is the opposite of what you want to happen when buying options, right? So you want the contract to lose value until it gets to $0 or as close to $0 as possible. This means that you can keep the entire premium that you got paid and go off on your merry way. So you can see the difference between option buyers and sellers. When buying options, you can make more money, but the risk is way higher to lose all your money. When selling options, you'll collect a small premium, but you'll have a way higher probability of winning the trade. Now, this is very important to understand when it comes to the wheel strategy. The second thing that we need to understand is how to protect ourselves from these obligations that all option sellers have, either having to buy shares or sell shares at a given strike price. You see, these obligations can make the trade very risky if we don't fully understand what we need, and that is collateral. We need collateral whenever we sell options. Anyone telling you that you can sell options naked, as in without collateral, isn't really doing you any favors, because this is a surefire way to blow up your account and actually even end up owing more money than you have. So we don't want any of that happening. So pay attention. There are two forms of collateral that you can have. When you sell call options, your obligation is to sell shares at the strike price if that strike price is reached. So the collateral that we will need for selling calls is going to be shares in the company. Now, one option contract controls 100 shares of the underlying company. So in this case, we will need 100 shares of the company that we are trading for every one option contract that we sell. So if we want to sell 2 option contracts, then we will need 200 shares of whatever the company is. If we want to sell 25 contracts, then we will need, well, 2,500 shares of the company. You need shares as collateral because let's say you lose the trade, then because of your obligation, you will be forced to sell shares at the strike price. So you need the shares to begin with and able to sell, right? Now, when selling puts, your obligation is that you will be forced to buy shares of the company at a given strike price if that strike price is reached. For this, we need collateral in the form of cash. You will need to have enough cash in your trading account to be able to buy shares of the company. Again, 100 shares for each contract sold. This leads us to the term that we should really be using when selling options: covered calls, and cash secured puts. Your stock is covering your positions when selling calls, and your cash is securing your positions when selling puts. Now, before putting all the pieces of the wheel strategy together, we need to understand the third and probably most important factor of being consistently profitable when selling options, and that is your probability of success. Now, I can sit here all day and explain the math behind the probability of success with options, but nobody wants that. So if you want to take a deep dive into that, you should watch my full breakdown video right here of selling options, and I go into everything and more, so click there and watch. But to keep it simple, the winning formula is as follows. For the highest probability of success, we want to be selling options with an expiration date of 30 to 45 days out, maybe even 60 days out. Now, your strike price should be at least 84% chance of expiring out of the money. Now, the reason that you want an expiration date of at least 1 month is because if you choose anything less, you won't collect that high of a premium, and you will most likely have to wait until expiration to see if you'll win or lose money on that trade. As opposed to selling options with 1 or 2 months out, you will collect a higher premium and also have enough time to collect profit along the way and close out your position early. Now, I did a whole video explaining the difference between weekly and monthly option contracts, so click here and get a full breakdown of that. Now, you're going to want at least an 84% chance of expiring out of the money because that's how we will win the trade, you see, by having the option expiring out of the money and the stock price not reaching that strike price. Now, the probability of 84% translates to a 1 standard deviation move on the stock. And again, do go watch my other videos where I break down all of these things more in depth because I know there's a lot to take in. But essentially, we can calculate the probability of a stock moving within a certain range, and based off of that, the statistics show us that 84% of the time, the stock will not reach that strike price by expiration. This is good for option sellers. Okay, so now we know we should be selling options rather than buying options. We understand that we need collateral and what collateral we need, and we have a plan of attack with the strike prices, the expiration dates, everything. Woo! This is exciting. Well, now it's time to put it all together in the wheel strategy. But before we get into the next step, I want to give a big shout out to Webull. I'm going to go ahead and leave a link down below for you to get 5 free stocks when you open and fund an account with Webull. All you have to do is open an account to get 2 stocks valued anywhere between $3 and $300. Then when you make a deposit of any amount, you will get 3 more stocks valued anywhere between $8 and $3,000. On top of that, Webull will give you $5 in free crypto after your first crypto trade. So go sign up and claim your free money with Webull, link down below. Okay, so what is the wheel strategy? Well, let's break it down. The first thing that you will need to begin the wheel is cash. This cash will be used as collateral for your first trade, which will be to sell cash secured puts on the stock that you want to trade. You will collect a premium and hope that that stock does not go down and reach your strike price. If the stock doesn't reach the strike price, then great, you get to keep the entire premium. Now you do it again. Sell another cash secured put on the same stock, and again, you will collect premium. Cha-ching, cha-ching, thank you very much. You will continue to do this over and over and over again as many times as possible until at some point the stock will reach the strike price and you will be forced to buy shares of that company. That's fine because remember, we have the cash to do so, right? That was our collateral. So if that happens, okay, now we buy the shares of the company and now we own shares of the company. Well, now what? This is where phase 2 comes in. We will now sell covered calls on our stock using our shares that we now own as collateral. We sell covered calls and collect a premium, and then we hope that our strike price is not reached. If our stock price is not reached, then perfect, we get to keep the entire premium, and then guess what? We repeat this process over and over and over again, collecting more and more premium. We sell covered calls and collect the premium. Sell more calls, collect more premium. Over and over until, yep, you guessed it, the strike price is reached and then you are forced to sell your shares. Okay, so now we sold our shares and we are left with cash. I wonder what we can do now with that cash. Well, this is where we start the process all over again, completing the wheel. you're going to again use that cash and sell cash secured puts. Sell puts, get paid. Sell more puts, get paid. Over and over as many times as you can. Then at one point you get assigned, well, then we start selling covered calls. Sell calls, get paid. Sell calls, get paid. All day USA. And the wheel continues to turn. Now let's talk about the risks and things that you want to keep in mind when using this strategy. First and foremost, you want to be using these option strategies with companies that you wouldn't mind owning yourself. You don't want to do the wheel strategy with stocks that are not good, solid companies, because if the stock continues to go down over time, then it doesn't matter how much premium you collect. By selling options, your stock position will continue to lose more and more money. And then it'll be really hard to recover. You'll either have to wait a long time for it to recover, or you just take a loss, and that's never good. So only good, solid stocks that will hopefully trend upwards over time. But Alex, how do we pick winning stocks? Well, what a great question, and coincidentally enough, I did a whole video on how to pick winning stocks. Click right there, check it out. Now, the next thing that you want to keep in mind is that you do not need to wait until expiration when selling puts or selling calls. Since we are selling options 1 month out, you can close your positions around 2 weeks in, depending on how much premium you will get to keep, right? If you close your positions early and take profit, you could immediately turn around and put on another trade. This way you can get more trades in, and that can lead to sometimes having more profit. Lastly, understand the risk of this strategy. Now, we already discussed to start with good, solid companies, but let's say this happens. You own 100 shares of a company and you sell a covered call on that. Your strike price is hit, and then that stock continues to go way up beyond your strike price. In this case, we'll lose our shares, but also we will be losing the potential profit of whatever we missed out on. If we sold a call with a strike price of $50 and that stock price is now trading at $75, then we will be forced to sell our shares at $50. And then we will lose the potential profit that we would have made between the $50 and the $75 it's trading at now. Now, this certainly is annoying, but you need to keep in mind that this is the risk when using the strategy. So you need to ask yourself, what's worse, losing actual money or the idea of not making money? Now, the most important thing that you want to keep in mind about the wheel strategy, and this is where it really clicked for me, is that this strategy combines passive income, which is consistent income that we take in by selling options, with an ever-growing buying power that will ultimately lead to bigger and bigger profits. The more premium that you can collect, the more cash you'll have. The more cash that you have, the more shares you'll be able to buy. This in turn will lead you to be able to sell more contracts of the given company. And what do selling more contracts mean? Well, it means more profit. And the snowball continues and gets larger and larger. Now, to be successful with this strategy is really going to depend on your understanding of selling options and taking a deeper dive into that. So go ahead and click over here to watch my video on selling options. It will really give you, I think, a better understanding of everything, and you could use that together with everything learned in this video. Now, if you want to check out what stocks and options I invest in, you can check out the link down in the description. That is my private Patreon group. So whenever I buy a stock or sell a stock, I will post it there. And of course, go ahead, give this video a like and a subscribe for more investing content. Thanks so much for watching, and we'll see you on the next one.